Let's bring in our next guest. Simon Redman is Director of Corporate Ratings Commodities over at Standard & Poor's, and he's joining us now. Simon, pleasure to speak to you. Thanks very much for joining us. S&P downgraded Chevron a couple of months ago. Of course, had that Moody's downgrade come through at the end of last week, saying that they expect the oil price to remain lower for longer. Was that one of the considerations behind your downgrade of Chevron as well?
Yeah, well, that's right. I mean, clearly, credit quality depends on a company's ability to generate cash, service its debt. Lower oil prices mean lower cash generation and therefore less cash available to service debt. So yeah, we revised our oil price assumptions back on the 12th of January this year, and we're over the month or so after that, we had a number of rating actions, including one on Chevron.
Yeah, any other factors, I guess, that impedes the credit outlook for these companies? Of course, falling commodity prices is a big concern, but here, of course, we're talking about LNG, right, and there's concerns about a bit of an oversupply in the LNG market. There is, of course, concern about that very point when you look at the oil market as well.
Sure. No, look, I mean, a lot of commodities appear to be in a state of oversupply. Yeah? You can talk about oil, you can talk about iron ore, but yeah, the LNG is slightly different because a lot of the 40% growth or so over the next 5 years in LNG production is actually already contracted. So the volumes, the offtake is already, if you like, pretty much guaranteed. It's just the price of that, which may be a little bit lower than some of these guys anticipated when they invested in these huge mega projects. So it's a factor for credit quality. I think the interesting question is, what impact does that have on the ongoing investment in new projects? And will the buyers in Asia and elsewhere be so keen to sign up new contracts on long terms, over a long term, and on similar terms, right, for the long run to underpin new investment in LNG?
Well, that's been a concern here, that we might see a renegotiation of some of those long-term contracts by customers, and then that will erode earnings of some of these big companies going forward because they're going to want to renegotiate, obviously at a lower price if prices are falling. Is that something that's on your radar as well? Because a number of the big majors here said they don't think that customers are going to want to renegotiate their contracts. They have faith that the customers are going to pay the higher price that they signed up to, which perhaps might seem a little bit naive from a layman's point of view.
Right, okay. Well, I guess one of the sort of disconnects here is you've got these long-term contracts, and the LNG market's been around for decades. It's been through a number of cycles before. And on the whole, these contracts have held good. So it's in the interests of the buyers to have that guaranteed supply over time, and sometimes they pay a bit more, sometimes they pay a bit less. And I think one of the reference points that's come up over the past few years is the spot market in Singapore. And that gives a reference point. That gives some transparency to the market. But that spot price for landed Asian deliveries isn't actually the price that most of these producers are getting, because of the long-term contracts that we talked about. So I think, if there is absolutely the risk that some of that long-term contract reliance that we look at from a credit rating perspective and the producers look at in terms of their future cash flows, maybe that could change, but fundamentally that's not the base case. Because at the end of the day, the buyers and the sellers know that it's a long-term industry. And yeah, at points in the cycle, it'll be in the favour of the buyers, and at points in the cycle, it'll be in the favour of the producers.
There's also been talk here at LNG 18 as well about a move away from contracts to spot pricing, to creating some sort of benchmark for gas prices, but then there's some concern that also may lead to an oversupply. From a ratings point of view, is that something that you've looked at, and would there be a preference to see pricing based off of something like a spot price solely, rather than with the contracts that we see negotiated between customers?
Right. I mean, look, I guess from a rating perspective, it's a question of certainty. It's a question of risk and certainty. And if you've got a long-term contract, I mean, the average rating that we have on off-takers of LNG is A-. So some are higher, some are lower, but the average rating we have is A-, which is a relatively high rating. So to have a contract with a creditworthy counterparty is probably a better story from a credit perspective than to have a reliance on the spot market, which is of course what, for example, in North America, you've got a reliance on Henry Hub gas pricing. Prices, gone from $12 an MMBTU, down to $2 an MMBTU over the past couple of years. So I've got to say, in terms of visibility on future cash flows, of course, if you've got a long-term contract, that's got to be a good thing. And that's exactly what's underpinned the investment and the growth in LNG, that we've seen we're seeing at the moment, and we've seen over the past few decades.